Let's quickly revise chapter 2 of our syllabus, which is framework for preparation and presentation of financial statements. The components of financial statements are four: balance sheet, statement of profit or loss, cash flow statement, and notes to accounts. Significant accounting policies, statements showing changes in equity are also part of financial statements, but however not mentioned here. There are a lot of people who are dependent upon these financial statements for their day-to-day operations or their decision making. People like investors, whether to invest in the company or not, they decide looking at your financial statements. Same applies to your employees, and same is the case with the people who give you money, borrowers, lenders, and also the people who have do business with you, people who basically sell the goods to you, and also the people who buy the goods from you. Financial institutions, government, all of these people are dependent upon your financial statements to understand your credibility. So these are the users of financial statements. Whenever you prepare financial statements, we need to always prepare it based on these three fundamental accounting assumptions. What are the fundamental accounting assumptions for preparation of financial statements? Going concern, accrual, consistency. These are the same what we discuss in accounting standard 1, disclosure of accounting policies also. Here also we tell that fundamental accounting assumptions is going concern, accrual, and consistency. Whenever an organization starts preparing its financial statements, it should ensure that, or it will always assume that it is going to survive for the foreseeable future, or it is going to continue to the foreseeable future. So there is no intention or there is no necessity to shut down its operations in the near future. Whenever the organization is a going concern, then the items will be represented at their original cost or historical cost, non-current items. Current items based on the standard that is applicable. But whenever the financial statements are prepared for an entity which is not a going concern, and the going concern ಮೇಲೆ ಒಂದು question mark ಬಂದ್ರೆ, then all the assets and liabilities should be shown at fair value. Get it? If it is a going concern, then non-current assets at historical cost, current assets at settlement price or cost, whichever is less. Different standards will apply. There are different valuation principles when the organization is going concern. However, when the organization is not a going concern, put all the standards aside, do valuation of all the items in the balance sheet, all the assets and all the liabilities. At what value? Very good. Then accrual means the transactions in these financial statements are recorded as and when it has appeared, as and when it has occurred, and not necessarily when it is affected in cash. If there is an expense incurred during the period, though it is not settled, it will appear in the financial statement as an expense in P&L and as a liability in balance sheet because it is not paid. It is not like expense will be written only when it is paid. Got it? Last one is consistency. When we prepare financial statements, we can definitely compare this with our previous year financial statement because we have prepared these financial statements based on the same accounting policies and principles what we followed in the previous year also. Understood? Then we discuss the qualitative characteristics of financial statements. Financial statements are prepared for the purpose of understanding, and the relevance of it is it will help us get the timely information, and also it will help us identify the benefit and cost analysis. How much benefit do I get, or how much cost I have incurred in acquiring the company's shares, or how much cost I have incurred inside the company, how much benefit am I getting it from the company by way of EPS. Then comparability. It will help me compare the business not just with its previous year but also with its competitors in the industry. And lastly, reliability. If I have to trust a company's progress, that is based on the financial statements which are audited and the audit report. For auditor to audit, first the financial statements have to be prepared. So financial statements which are audited helps me rely upon the progress of a company or rely upon the information that is provided by the company. Talking about how the items will be presented in the balance sheet, there are four measurement techniques. What are they? Historical cost, current cost, realizable value, present value. Historical cost is the cost that I paid to acquire a product. When I purchased that asset 5 years ago, 4 years ago, whatever I paid that day becomes the historical cost. And the same product, what is the price of that product today is my current cost. The asset that I already have in my balance sheet, what is the current market price of that product? That's current cost. If in case I buy that asset today, the price that I pay is current cost. The price that I paid that day is historical cost. Today, if I decide to sell that asset, how much money will I get? Is my realizable value. I'll repeat. The money that I paid to buy the asset 5 years ago is historical cost. Same asset, same model, if I have to buy today, what I should pay? Current cost. If I sell the asset what I bought 5 years ago today, the money that I receive is realizable value. Using this asset in the next 3 years, in the next 4 years, what cash will I generate? That becomes my cash inflows. If I discount it to today's date, the present value of the future cash flows this asset is going to generate will become my present value of the asset. Based on the situation, circumstance, and the applicable provisions of the applicable accounting standard, we will decide which value to use for which item in the balance sheet. But these are the four valuation principles. Last part of this unit is capital maintenance. The objective of capital maintenance is ensuring that we do business in this year at the same level at which we did business last year. Last year we had capital of 10,000 units. This year our capital should not go below 10,000 units. Irrespective of what is the market price, I should be able to do the business at the same level, not at a higher level, at least at the same level. When I say level, I'm not talking about amount, I'm talking about units. I'm talking about units in stock. So this is to ensure that we don't withdraw capital. And a businessman can withdraw his drawings by way of profit, but not eat into the capital. So this is ensured by capital maintenance. Here they tell how much is the capital that should be maintained. How much is the capital that should be? Very good. So there are multiple ways. First one is financial capital. Second one is physical capital. Under financial capital, we have two. One is historical cost. Second one is current purchasing power. Historical cost is based on an assumption that the price that was there at the beginning of the year is the price that is there at the end of the price that was there at the beginning of the year is the price that is there at the what is my opening stock in units? I'll determine that. Multiply that with the historical cost what was there at the beginning. 10,000 units, let's say. Beginning of the year rate is 10, end of the year rate, I don't care. I'll take the historical cost rate of 10 only. 10,000 units were there at the beginning, 10 rupees per unit is the rate at the beginning, multiply. 1 lakh should be the capital that I should maintain. From 10,000 units what I had at the beginning, when I sold these units, let's say I've sold these at 11 rupees. So 10,000 units into 11. I've got 1 lakh 10,000. The capital that I should maintain is 1 lakh. But I have 1 lakh 10. I can withdraw 10. If I withdraw 11,000, my capital will become 99. There is negative retained earnings of 1. I have overdrawn my capital. So the closing capital to be maintained is computed using the historical cost. That is the first method. Under the second method, current purchasing power, we always take 100 as base price. They'll tell you the purchasing price index at the end of the year. They say purchasing price index at the end of the year is 120. If they say 120, it means whatever is 100 rupees at the beginning of the year is 120 rupees at the end of the year. Opening capital was 10,000 units at rupees 10. 10,000 units at rupees 10 is 1 lakh. 1 lakh at the beginning of the year is equal to 100 rupees at the beginning of. At the end of the year, let's say the price index has become 120. So we do 1 lakh opening capital into 120 divided by 100. That gives me capital to be maintained as 1 lakh 20. What is the capital to be maintained? How do we determine capital to be maintained under current purchasing price? Very simple. Opening capital multiplied by closing price index divided by base price, that is 100. So we got 1 lakh 20,000. That should be the capital to be maintained. After I sold those units, let's say I realized a capital of 1 lakh 25. The selling price of all the units, cash and other assets that I have with me is 1 lakh 25. Capital that is there closing is 125. Capital to be maintained is 120. 5,000 is available for withdrawal. Get it? What if I withdraw more than 5? Then my retained earnings is negative. What if at the end of the year, the capital that is there is only 1 lakh 18? Capital to be maintained is 1 lakh 20. I have 2,000 deficiency in my capital. My capital is less by 2,000. We call it negative retained earnings. This is the second method which is called as current purchasing power. Then we have the last method called as physical capital maintenance. Under physical capital maintenance, we do it like historical cost. But the rate that we apply will be closing rate. Beginning of the year I had 10,000 units and the opening rate was 10 rupees per unit. I want to maintain enough capital to buy 10,000 units in the next year. For that, I will take the closing rate. Beginning of the year rate is 10. Let's say closing rate is 12. I'll do 10,000 units. multiplied by 12 rupees per unit. How much is 10,000 into 12? 1,20,000 is the amount of capital that I should maintain at the end of year to do same business next year. Let's say my capital at the end of the year is 1,10,000. I have shortage of 10,000, which is called as negative retained earnings. What if I have 1,25,000, 1,25,000 closing capital? Capital to be maintained is 1,20,000. 5,000 can be withdrawn. I'm not telling should be withdrawn. 5,000, it is available for withdrawal as profit. And that's our physical capital maintenance. And this is the complete discussion on framework for presentation and preparation of financial statements.